Okay, dear students, good evening to everyone. I did mention in the previous class that from here onwards, we'll be discussing the past paper question. In this question, actually, we'll see the application of IAS 32 and the application of IFRS 9, and I would say a little bit IFRS 13, but it is there. So it's heavily on IAS 32, IFRS 9, and little bit IFRS 13. It's a 25 marks question. Look at this, part A. Discuss the accounting treatment of convertible bonds. Discuss the accounting treatment of convertible bonds. Stop. When we say convertible bond, it means hybrid instrument. Repeat, convertible bond is a hybrid instrument. And can I say it is the requirement of IAS 32 that whoever has issued the convertible bond, whoever has issued the hybrid instrument, you have to split that into debt component and equity component. Repeat, it is the responsibility of issuer of a hybrid instrument to split that into debt component and equity component. The debt component is a financial liability. The debt component is a financial liability. And we know that financial liability means in case of convertible bond, there is a possibility at maturity, organization might be required to pay cash. So can I say if investor is asking for the cash, if investor is asking for the cash, then it will be your contractual obligation to deliver cash. So can I say the contractual obligation to deliver cash, that is your actually debt component, it is your financial liability. And there's another possibility that instead of cash, investor can ask for the fixed number of shares. Obviously, we know that in day one, exactly convertible bond, if they will be converted, then in exactly how many shares they will be converted. So definitely, if the investor is asking for the cash, then you have a contractual obligation to deliver cash, financial liability. If investor is asking for the shares, so you have to provide fixed number of shares, which is an equity instrument. So it is the requirement of IAS 32 that you have to split convertible bond into debt and equity component. So we'll be discussing other things as well. Don't worry at all. In the financial statement for the year ended 31st May X7. So you need to discuss accounting treatment of convertible bond in the financial statement and for the year ended 31st May X7. How many marks are there? 9 marks. If you ask me, so out of 9, you should be able to get at least 7 marks. How? We'll discuss. Part B, discuss the accounting treatment of share exchange in financial statement for the year ended 31st May X7, 6 marks. We'll see that share exchange. Obviously, by looking at the scenario, you will be able to discuss the accounting treatment. C, discuss the accounting treatment of Winston bonds in the financial statement for the year ended 31st May X7. Your answer should explain the impact of the bonds in Aaron's statement of cash flow. Wow. Read it again. Discuss the accounting treatment of Winston bonds. So we need to discuss accounting treatment of Winston bonds in the financial statement for the year ended 31st May X7. In addition to that, they're asking something else also. Your answer should explain the impact of the bonds in Aaron's statement of cash flow as well. So just do not discuss the accounting relating to the Winston bonds. You need to also explain impact of bonds in Aaron's statement of cash flow. And let me just give you a little idea. For example, if I'm the investor, in the bonds, and whatever investment I have made in the bonds, then it is an investing activity. If I'm the investor, so I'll be receiving the cash. I'll be receiving the interest. So interest income received is an investing activity. But if I'm the one who has issued the bond to raise the finance, so instead of investing, it becomes the financing activity. And interest paid, normally interest paid we take in the operating activities. So we have to see either we are the investor of the bonds or we are the issuer of the bonds, because the interpretation treatment in the cash flow statement changes when you are the investor of the bonds and when you are the issuer of the bonds. So treatment in the cash flow is different. The directors of ARN would like advice about the financial reporting treatment of some financial instrument transactions that took place during the year ended 31st May 7. The directors of ARN would like advice. Okay, convertible bonds. Look at this. ARN issued 1 million convertible bonds on 1st June X6. ARN issued 1 million convertible bonds on 1st June X6. The bonds had a term of 3 years and were issued for their fair value 100 million. Okay, which is also the par value. Interest is paid annually in arrears at a rate of 6% per annum. This 6% is a coupon rate, cash interest rate. Bonds without the conversion option attracted an interest rate of 9% per annum on June X6. Basically, according to IAS 32, if we have issued the convertible bond, which Aaron has done it, so it is the responsibility of Aaron to split this convertible bond into debt and equity component. And obviously, for calculating debt component, simply the debt component is equal to, can I say the debt component is equal to the present value of future cash flows. And there will be two types of cash flows. One is cash interest payment, and the second is payment at the time of redemption. For discounting the future cash flows, we need market interest rate on similar bonds, but without conversion option. So this 9% will be your discount rate. Okay. The company incurs issue cost of 1 million. Now stop. Actually, if issue cost relates to the convertible bond, then how do we deal with the issue cost? Step one, first you have to convert the convertible, you have to split the convertible bond into debt and equity component. After that, issue cost will be allocated to the debt and equity component according to the amounts which we have calculated. I'm just assuming. Let's assume that 90% of the convertible bond relates to the financial liability, 10% assuming relates to the equity component. So the issue cost will be allocated 90% to the debt component and 10% to the equity component. But we cannot directly allocate the issue cost. Before allocating the issue cost, you have to first find out the carrying amount of financial liability, debt component and equity component. After that, issue cost of convertible bond will be allocated. The impact of the issue cost is to increase the effective interest rate 9.38%. So due to issue cost, what will happen? Effective interest rate will increase. And I hope everyone knows that in your financial statements, whatever interest comes, it is always the effective interest rate, and which is 9.38%. And one more thing, if there wasn't any issue cost, then your effective interest rate would have been 9%. You can read the question, why effective rate is increasing? It is increasing because of the impact of issue cost. So if you do not have the issue cost, then obviously 9% would have been your effective interest rate. At 31st May X9, the bondholders can opt to be repaid the par value in cash, which is 100 million, or they can opt to receive fixed number of ordinary shares in ARN. Now let me just give you exact idea relating to part A. What exactly you need to discuss regarding this convertible bond? I'm just telling you the main points. In your answer, the first point has to be that convertible bond. You have to just mention the convertible bond. Can I say the convertible bond is a hybrid instrument? And it is then after this, you will just explain that it is the responsibility of Aaron company to split this hybrid instrument into debt component and equity component. Student, this is not the full-fledged answer. I'm just giving you the main idea. So after that, obviously, you will be in a position to draft your answer. Step one, you have to tell your examiner, what do you mean by convertible bond? Convertible bond is a hybrid instrument. It is having the characteristics of debt as well as equity. So it is the responsibility of Aaron to split this hybrid instrument into debt component and equity component. Now the question arises, what about this debt component? Actually, debt component means your financial liability, because Aaron does have a financial liability, that is contractual obligation to pay cash, because at maturity, if investor is asking for the redemption amount, if investor is asking for the cash, so you have to provide cash. So debt component means a financial liability. You have a contractual obligation to pay cash. Obviously, here we are going to pay cash in two forms. One is annual interest payment, and the second is, you can say, the principal repayment. But obviously, it depends on the investor. If investor is asking for the principal repayment, so you have to provide. So simply, the debt component is a financial liability. Is a financial liability. Means Aaron is having the contractual obligation to deliver cash. And can I say there will be two types of cash payment? One is annual interest payment. Yes or no? Annual interest payments and capital. At maturity, if investor redeems the bonds. So issue of the capital will only arises if investor redeems the bond. Otherwise, there's no capital repayment. But when we say contractual obligations, so logically your financial liability is equal to contractual obligation to deliver cash. And there are, when you say cash, obviously you will be paying annual interest payment and capital repayment. Logically, you will be paying the capital if investor goes for the redemption option. When we say equity component, can I say if obviously it depends on the investor, if investor is converting the convertible bond to the shares, then contract says you have to issue fixed number of equity shares. What do you mean by fixed number of shares? Actually, in day one, investor and both, they exactly know that if investor is asking for the to convert the bond into shares, so investor knows exactly how many equity instrument investor is going to get. And plus, Aaron companies also knows exactly how many fixed number of shares they will be issuing. So basically, the fixed number of equity instrument which Aaron company is going to issue, that is the equity instrument. So that is fixed number of equity shares. So there's a contract to issue. The contract to issue fixed number of equity shares. Okay, now, after that, you have to explain how to split hybrid instrument into debt component and equity component. First, you have just given the definition of the debt component and the definition of the equity component. After that, you have to first explain. Directly going for the numeric will not help you. So please, for splitting the hybrid instrument into debt component and equity component, basically, you will use market interest rate 9% as your discount factor. So you need to explain the examiner that market interest rate on similar bond without the conversion option will be used as a discount factor. And by using this 9%, Aaron company can calculate the debt component. How? Because then you will tell the examiner debt component is equal to present value of all future cash flows. Debt component, financial liability, that is equal to present value of future cash flows. Okay, now, just after explain, you have to first explain. If you're going directly for the numbers, numerics, you will not be getting marks. How to calculate the debt component, please, you have to, even you are writing in a single line, it is acceptable, but you have to tell us that debt component, for calculating debt component, market interest rate without conversion option on similar bond, which is 9%, will be used as discount factor. Debt component, or you can say the financial liability, is equal to present value of future cash flows. Okay, now, convertible bond is having a coupon rate, cash interest rate 6%, number one. Number two, the maturity period is 3 years. So very easily we can calculate the debt component time. Let's say T1, T2, and T3. Cash flows. 6, 6, and can I say 6? And since redemption will be at pars, then the 100 million. 9% is your discount factor. So in year 1, 1.09 minus 1, 1.09 minus 2, 1.09 minus 3. Present value. Let me use the calculator. 6 into 1.09 minus 1. I'm getting 5.5. Then the second year, 5.05. 106 into this. Let me use this. Student, please recheck. I'm getting 92.4. I'm getting a debt component 92.4. Can I say this debt component will be deducted from the total amount, which is 100 million? So balancing figure will be your equity component. So equity component is the balancing figure. Equity component. Can I say 100 minus 92.4? I'm getting 7.6. It means, when did Aaron issued these bond? Wait for this 9.38, please. They issued at 1st June X9. So just wait for that 9.38. 1st June, I think it was X6. Please recheck the date, whatever it is. Let me just show you the double entry, debit and credit. It will give you the more clarity. Bank, everything is million, is in million. Can I say bank is debited by 100 million? Debt component, financial liability. So your debt component will be credited by 92.4 million. Equity component will be credited by 7.6. Now listen, we have a split convertible bond into debt and equity component. Step 1, split the debt convertible bond into debt and equity component, which we have done it. After that, you have to allocate transaction cost on the basis of debt and equity components carrying amount. In day 1, debt component is 92.4, equity component is 7.6. Since the total amount is 100 million, so you can say that logically, whatever is the issue cost, can I say 92.4% of issue cost should be allocated to the debt component and 7.6% of the issue cost should be allocated to the equity component. Repeat, we cannot directly allocate issue cost of hybrid instrument, issue cost of convertible bond to any component. Step 1, you have to split the hybrid instrument into debt and equity component, which we have done it. Now in step 2, you have to allocate the issue cost. Issue cost is 1 million. Now let me just show you the double entry of the issue cost. With the issue cost, when I'm going to allocate the issue cost to the debt and equity component, both will be reduced. Logically, issue cost will reduce. No, nobody does discounting to the issue cost. So basically, we are paying, obviously, issue cost you are paying in day 1, it is itself in present value terms. Now look at this, debt, equity, and bank. Issue cost is 1 million. So bank is credited by 1 million. Logically, debt will be debited by 0.924 and equity will be credited by 0.076. I hope if you people use the calculator, the total sum has to be 1. 0.924 plus 0.076. Yes. Okay, now, due to this allocating of issue cost, your debt component will reduce, your equity component will reduce. It means that if you ask me what will be the debt component value in day 1, so you have to calculate the debt component value 92.4 and logically can I say 0.924. And equity component value will be 7.6 minus 0.076. So basically, debt, equity, we calculated 92.4 and 7.6 and simply deduct the issue cost 0.924 and 0.076. So let me use the calculator. 92.4 minus 0.924. I'm getting 91.476. 7.6 minus 0.076. I'm getting 7.524. So basically, step 1, we calculated debt and equity component. After that, we have just split the issue cost. Now, the question is effective interest rate, which examiner has given us 9.38%. What are we going to do? I think at the start of the question in this class, I did discuss when we are calculating finance cost for the P&L, we always use effective interest rate. Due to issue cost, your effective interest rate is 9.38%. And I did mention one more point. If there wasn't any issue cost, then the same 9% would have been treated as the effective rate. So right now, effective rate is different than the 9% because of the issue cost. And it is also logically mentioned in the question as well. So how we are going to utilize that 9.38%? Let me just give you the idea. Let's see, on 1st June 2006, debt component is 91.476. Simply add finance cost. For calculating finance cost, you will be using 9.38%. That is effective rate. Let me take 9.38% of 91.476. If I take 9.38%. 91.476, and I'm getting, students, can you check? I'm getting 8.58. Logically, 8.58 will be added, less interest paid. Can I say cash interest is paid by utilizing the coupon rate? Coupon rate is the rate which is written with the bond, which is 6% in our question. Less interest paid. 100 into 6%. Cash interest is always paid on par value. 31st May X7, the value of the debt component. So let me use a calculator. 91.476 plus 8.58 minus 6. Students, I'm getting 94.056. I hope you people are also getting the same value. Yes or no? Please, you can reply if there's any difference in the value. Okay, now. In the P&L, in the profit and loss, 9.58 will be taken to the profit and loss as finance cost, and in SOFP, the debt component value will be 94.056. So simply, the finance cost 8.58 will be charged to P&L, will be charged to profit or loss. Carrying amount of debt, you can say financial liability, will be 94.056 million on 31st May X7. So I strongly believe that each and every calculation and discussion is clear to everyone. And let me repeat quickly what you exactly have to write. I've just given you the idea. Number one is, students, you have to mention that convertible bond is a hybrid instrument and it is the responsibility of the issuer of the hybrid instrument to split that into debt component and equity component. After that, you have to give the definition of financial liability. Financial liability means contractual obligation to deliver cash. You can explain here the cash payment here is interest as well as capital repayment, but if you can add more, capital repayment will only arises if investor goes for the redemption option. Then explain the equity component. Equity component means there's a contract to issue fixed number of shares. After that, you have to explain the examiner how do we calculate actually debt component, or how do we split hybrid instrument mathematically. For that, you have to mention that market interest rate on similar bonds without conversion option is used as discount factor to calculate debt component. To calculate the value of the debt component. To calculate the value of the debt component, and after calculating the value of debt component, equity component is a balancing figure. Equity component is just a balancing figure. Okay. And after calculating the debt and equity component, issue cost will be allocated according to the values of debt and equity component. And issue cost will reduce the carrying amount of debt and equity component. After that, you will explain the finance cost which will be charged to the P&L. It will be on the basis of effective interest rate. And effective interest rate here, it is 9.38%. Effective interest rate here is 9.38%. I hope the entire discussion and a little bit, I mean, more than a little bit, calculation is clear to everyone. Students, still here any question? Please, you can ask now. Still here any question? Please ask. Yes or no? Still here any question? Yes or no? You can just tell me. Any question, student, please explain. No, 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 no. Listen carefully. You are not supposed to make any double entry for the redemption. If you ask me, I can tell you the entry. On redemption, if investor is asking for the cash, at that time, automatically your liability amount will be 100 million. So debt will be debited by 100 and cash will be credited by 100. That is the entry for the redemption if investor is asking for the cash. Because slowly and gradually, you will reach 200 million. And you can see that here also. Look at this. 1st June X6, look at the amount of the debt. 91.476. And at the end of the year, what is happening? Debt component has increased. So over 3 years, you will get exactly 100 million. Now listen, if at maturity examiner is asking for the cash, entry will be debit debit your debt component by 100 million, credit bank by 100 million. If investor is asking for the shares, you will debit the debt component by 100 million, and with the par value, share capital will be credited, and over and above the share premium will be credited. Is this clear to everyone? But right now, we are not going for the redemption. They have not asked us. Okay. Now let's come here. This is done, okay? Part A. But student, okay, I'll tell you at the end of the video what you need to do. Part B. Discuss the accounting treatment of share exchange in the financial statement for the year ended 31st May 7. How many marks are there? 6. Okay, let's read. Share exchange. Aaron held 3% holding of shares in Smart. Stop. Number 1. Can I say if I have made investment in shares, point 1, it is my financial asset? Yes or no? Please quickly reply. If you have bought equity instrument of another company, can I say equity instrument of another company is a financial asset for me? Yes or no? Please reply at least. Where is everyone? Where is everyone? Shares of other organizations in which you have invested, they are your financial asset. They are your financial asset. And let me know. Another student said, no, it is not a financial asset. Then what it is? Let us give a new name to this. It's equity. Wow. Great. If you are buying shares of other organizations, they are not your equity. They're the equity of other company, not yours. For you, they are financial asset. You are the investor. You are the investor. It is your investment. Okay. Now listen carefully. Investment in equity instrument. I'm just explaining, then I'll come here also. Just a minute. I think I did mention previously that we'll be discussing the past paper, and through past paper, we'll be discussing the relevant area of the relevant IAS or IFRS. Right now, I'm not giving you the answer of part B. Before that, I just want to give you a little idea. Investment in equity instrument. Listen carefully, students. If you have invested in the shares of other organizations, that investment is your financial asset. Now listen, investment in equity instrument. How many classifications are possible? Students, please reply. How many classifications are possible? Can I say there are two possible classifications? One is fair value through P&L. Two. One is fair value through P&L, profit and loss. Another is fair value through OCI. There are two possible classifications. One is fair value through P&L, another is fair value through OCI. Now, if you recall, we did discuss many times, if you have made an investment in an equity instrument of another organization and your business model is HFT, that is held for trading. Held for trading means you bought the shares and your business model is short-term trading. Whenever shares are bought with the short-term trading, always students remember one point, HFT by default comes in fair value through P&L category. HFT by default comes in fair value through P&L category. Held for trading. HFT by default comes in fair value through P&L category. Okay. So HFT by default comes in fair value through P&L category. There's a possibility that you have made an investment in XYZ company's shares and they are not, let's say, they are not HFT. Still, if you want, you can keep them at fair value through P&L category. But the concept is, whenever you bought shares for short-term trading purposes, then by default, they have to come to the P&L category. And in fair value through P&L, what happens? Initially, we keep the investment at fair value, transaction costs, expense out. Subsequently, on each reporting date, we need to remeasure the fair value of the financial asset, and changes in the fair value, they go to P&L. Okay, now, very important point. Let's say you have made an investment in XYZ company's shares, and let's say it is not for short-term trading purposes, number one. Number two, if organization wants to bring that investment to fair value through OCI, it is very much possible. Number one, it is only possible initially, and it is only possible after making an irrevocable election. It is only possible after making an irrevocable election. Okay, let's say a company has made an irrevocable election and it was not HFT, then what is the accounting? Now listen carefully, the accounting of fair value through OCI. Very important, okay? Number one, in case of fair value through OCI, in case of fair value through OCI, initially financial asset is capped at fair value plus transaction cost. Logically, in fair value through OCI, we are capitalizing the transaction cost. Second, changes in the fair value, they go to OCI, other comprehensive income. Changes in the fair value, they go to OCI, other comprehensive income. Third, if you have sold the investment which was at fair value, which was in the fair value through OCI category, then previously whatever gain or loss you have recognized in OCI, it cannot be recycled to P&L. Maximum you can just transfer previous cumulative gain or loss within equity. But a concept is, whatever previously gain or loss you have recognized in OCI, it cannot be recycled to P&L at the time of disposal of fair value through OCI financial asset. Now listen carefully, a very important point. What is that? I'm just assuming, okay, let me just bring a data a little bit here. No, please. Waleed, we always buy shares from where? Okay, tell me, students, from where do you buy shares? Can you tell me the name of the place? From where do we buy shares? Where is everyone? From a stock exchange, yes or no? Yes, am I right? So from when we are buying shares from a stock exchange, So can I say whatever is the value at a stock exchange, you will be paying the same value or you will be paying less or more? Please answer. What will you pay to the stock exchange? Same value or a different value? Is this possible? If a stock exchange says the share is having a value of $10, can you tell the stock exchange, no, I will be paying $7? That's not possible. Same market value, and we are studying listed company right now. Now listen carefully, please. Assuming day one fair value plus transaction cost is 20 million. I'm just assuming, okay? Please stay with me. Initially, the fair value plus transaction cost is 20 million. And look at the double entry. Financial asset, or you can say investment, is debited by 20. Bank or cash is credited by 20. This is the first entry. I just want to explain something. Now, year end. Assuming the fair value of this investment has become 25. So what we are going to do? Investment will be debited by 5. Fair value gain on investment. Fair value gain on investment. We'll take that gain to OCI, other comprehensive income. Now listen carefully what I want to explain. When we prepare SOCI, statement of comprehensive income, so let's say you have reached profit after tax. Once you have reached at PAT, after that we put a heading. The heading is other comprehensive income. So the fair value gain on investment you have to show here under PAT. Fair value gain on investment. The amount is 5 million. Okay. When it comes to SOFP, statement of financial position, obviously, if you ask me the value of the investment in assets, it will be 25 million. I just want to explain you something. But what about that 5 million? In SOFP, we are not using the title of OCI. Instead of OCI, we use the title of OCE, other component of equity. That will be 5 million. So we are not using the title of OCI in our SOFP. Instead of OCI, I'm using the title OCE, other component of equity. Okay. Now what? Let's talk about second year, year 2. Assuming 30th June 2000, I'm just putting in here, let's say mid of year 2. If we are doing like this, mid of year 2, investment is sold at fair value 27 million. Now try to understand. We have sold this investment for 27 million, which is the fair value of this investment. Okay, try to understand now. What IFRS 9 says, let me repeat that, tell you that first. According to IFRS 9, when you are selling your investment, which you have kept at fair value through OCI, listen the wordings. Immediately before the disposal of fair value through OCI investment, immediately before the disposal, IFRS 9 says do one thing. You just need to remeasure the fair value of your investment, and whatever change comes in the fair value, take that to OCI. Repeat. According to IFRS 9, just remeasure the fair value immediately prior to disposal. And whatever change comes in the fair value, take that to OCI. Now, we are selling our investment at fair value, which is 27. Now listen carefully. Debit, credit. Before making a entry for the entry for the disposal, what I'm doing? Investment debit by 2 and gain on fair value. Gain on fair value. OCI is 2. Okay. So immediately before the disposal, just remeasure the fair value, and whatever the change comes in the fair value, take that change to OCI. We have taken that. Now, let's say we have sold the investment at 27. So what is the big deal? I'll tell you. Simply bank is debited by 27. Investment will be credited by 27. Number one. Now listen carefully. What we did, we have simply debited the bank, credited the investment. Now, in the previous year, previously, there was OCE in your financial statement 5 million. In the current year, we have OCI 2 million. Number one. If you ask me, I can say that cumulative other component of equity is 7 million. Number one, at disposal, you cannot recycle the cumulative gain which you have in your OCI. Maximum, if you want, IFRS 9 gives you the permission to bring the change within the equity. For example, if any student makes the double entry of, let's say, OCE is debited by 7 million and retained earning is credited by 7, that is perfectly all right. But if you ask me, I'll say, what difference does it making? You're just playing within the equity. One equity component is debited, another is credited, your total equity will remain same. But the main thing is the cumulative change which is in OCI that cannot be recycled to P&L. Okay, now there's another very important point. What is that? Now try to understand. We sold our investment at fair value. Okay. Now there's a possibility. Chances are obviously very less, but let's assume. Examiner says, I'm just assuming, okay? Examiner says fair value of your investment. Fair value of your investment is, assuming 27 million. Fair value of your existing investment is 27 million, okay? But you are getting, in exchange, you're not getting cash. In exchange of existing investment, you are getting new shares from a different company. And the shares which you are getting from a different company, let's say, or assuming, let's just an assumption, okay? Basically, what is happening, that there's an exchange in the shares. Assuming, let's put it like that. We are taking class A shares from you and giving you the class B shares. But the main point is, fair value of the class B share is 28 million. Now, this is the problem. The problem is, your existing investment is having a fair value of 27 million, but the new shares which you are getting in exchange, they are having a fair value of 28 million. Obviously, IFRS 9 has told us one thing. When your investment is at fair value through OCI, then you have to remeasure prior to the disposal fair value of your existing investment, which is 27. But in exchange, the shares which I'm getting, it has a fair value even more than the fair value of my existing shares. Now, what should be done with that 1 million? Logically, that 1 million will go to P&L. Then if rarely it happens, but if it happens, that the fair value of share received in the transaction, if it exceeds the fair value of shares disposed of, in that case, difference goes to profit and loss. Just keep that point in your mind. That's it. Come here and wait for next 5 to 10 minutes. Come here. And just let's see what is happening here. On 1st June X6, Aaron purchased 10 million of listed bonds. No. Aaron held 3% holding shares in Smart, a public company. A public limited company. The investment was designated upon recognition as fair value through OCI. And as at 31st May X7 was measured at its fair value 5 million. So at 31st May X7, it is already at fair value, which is 5 million. The cumulative gain reported in the OCI held in equity relating to this investment is 0.4 million or 4 lakh. 31st May X7. The whole of the share capital of Smart was acquired by Given. Smart was acquired by Given. Okay. A public limited company, Aaron receives shares in Given with a fair value 5.5 million in exchange for its holding in Smart. Now listen carefully. First, what you have to explain, let me just show you. Obviously, first you just quickly need to discuss that investment in equity instrument, there are two possible classification. One is fair value through P&L and another is fair value through OCI. And after that, you just need to explain if shares are bought for a short-term trading purposes, then by default, they will have to come in fair value through P&L category. Okay. Otherwise, in case of making an investment not for trading purposes and making an irrevocable election, fair value through OCI category is applicable. After that, just you need to directly come on the main point. The main point is we are selling here fair value through OCI shares. Okay. So what you have to say, number one, prior to disposal, according to IFRS 9, we need to remeasure the investment to at fair value. Can I say here investment is already at fair value? Number two, in exchange, the shares which we are getting, shares in Given, they are having value more than the shares which we have. So what is happening basically? Fair value of shares received is more than the fair value of shares disposed of. In that case, 0.5 million will go to P&L and the previous cumulative gain, which is 0.4 million, you have to explain the examiner, it cannot be recycled to P&L. Maximum the cumulative gain at disposal organization can bring the change within equity. Simply you can say OCE will be debited and retained earning will be credited. Or you can just write a single line that is within equity change is permissible, but recycle is not allowed. Another point is what should be done with the shares which now you have taken in Given. Again, obviously it depends on the company. Initially they have to decide either the shares in the given company they want to keep at fair value through OCI or fair value through P&L. Main point is what you are going to do with the 0.5 million. Examiner really wants to see that. So never forget one point. Number one, prior to the disposal of fair value through OCI shares, you have to remeasure your existing investment. And if the fair value of shares received is more than the fair value of shares disposed of, then difference goes to P&L. It means if I just quickly show you the double entry, debit and credit, simply we are getting shares in Given company. So simply you can say investment. Now I'm talking about Given. 5.5. Investment in Smart is gone, which is 5 million. And gain on disposal, profit on disposal, that goes to profit and loss. This is very important. So first discussion and then there will be a little bit double entry. And let me tell you one more thing. Majority of the student, what do? They just go for numerics and then they don't go for explanation. Even in double entry, if you are making mistake, for example, you should not be, but let's assume if you are making mistake, but you are really good in explanation, you will get 90% of the marks. Because question is not ask us to make double entries. Question is asking us to discuss the accounting treatment. Now let's quickly come on part C. Discuss the accounting treatment of Winston's bonds in the financial statement for the year ended 31st March 7. And then they have also asked statement of cash flow treatment. Okay. This is a 9 marks question. Okay. Winston bonds. On 1st June X6, Aaron purchased 10 million of listed bonds at par and paid in cash. Repeat. On 1st June X6, Aaron purchased 10 million bonds. Purchase. Can I say? Financial asset. I have a question, students. When you made, let's say, when you make investment in debt instrument of another company, obviously it is financial asset for you. How many classifications are possible? Oh, okay, let me make it easier for you. Can you tell me? Obviously, there are 3 classifications. What are the prerequisites for each classification? Repeat. If you're making investment in debt instrument, it is financial asset for you. Number 1. Number 2, listen carefully. There are 3 possible classification. One is amortized cost. Second is favorable through OCI. Third one is favorable through P&L. In case of amortized cost category, students, what are the 2 conditions which you have to meet? Can I say one is the business model test? For amortized cost, business model is you will keep the investment till maturity. And contractual cash flow test. What is the contractual cash flow test? Can I say contractual cash flow test means there will be only contractual cash flows, that is interest and principal repayment. That is why, listen carefully, that is why if you have made an investment in convertible bond, you cannot keep that at amortized cost because contractual cash flow test is failed when you make investment in convertible bonds. So number 1, in case of debt instrument, amortized cost category is possible, but it has its own prerequisite conditions. Second, fair value through OCI. Now let me tell you, in case of fair value through OCI, you can keep the investment in fair value through OCI when your business model is that I will keep the investment till maturity plus sell. Sell means if we come across any other opportunity which gives us a higher return than existing investment, then we will sell the existing investment to get the better investment. If this is the case, then you will go for fair value through OCI. Last, if you made the investment in debt instrument and that is for short-term trading purposes, then we go for fair value through P&L. Now let's come here. Aaron purchased 10 million of listed bonds at par value and paid in cash. These bonds had been issued by Winston. We are the investor. Remember, we are working for Aaron and we are the investor. An entity operating in a video games industry that's happening nowadays. The bonds are due to be redeemed at a premium on 31st March 9, with Aaron also receiving 5% interest annually in arrears. So cash interest which Aaron is getting is 5%. The effective rate of interest in the bond is 15%. I think we have already discussed many times. In the P&L, we take effective interest. Either it is going to be interest income or interest expense. Aaron often holds bonds until the redemption date, but will sell prior to maturity if investment with a higher return became available. Students, fair value through OCI. So you have to explain first the examiner accounting of fair value through OCI. Initially, we keep the investment at fair value plus the transaction cost. Second, interest income is recognized by using the effective rate that goes to P&L. Another point, cash interest received is on the basis of coupon rate, and that is applied on par value. Another point, at the end of the year, investment is remeasured to fair value and changes in the fair value, they go to OCI. Final point, if investment in fair value through OCI, debt instrument, okay? Debt instrument which is capped at fair value through OCI, if it is sold, then previously cumulative gain or loss in OCI is recycled to P&L. So you have to discuss all these things. On 31st May 7, Aaron received the interest due on the bonds. However, there were wider concern about the economic performance and financial stability of the video games industry. Now stop. When it comes to IFRS 9 impairment, so IFRS 9 impairment accounting is applicable. Number one, the impairment accounting is only applicable when you have made an investment in bonds, and impairment accounting is applicable only on two categories of your investment. Number one is amortized cost category, and the second is fair value through OCI category. As a result, the quoted prices of Aaron Company investment at 31st May X7 was 9 million. Quoted price. Now listen carefully. If I give you a little bit idea of IFRS 13 fair value measurement, actually IFRS 13 fair value measurement gives us three level of input to us: level 1, level 2, and level 3. Can I say out of these three, which level input value is more reliable? Can I say level 1 input? So whenever you have active market of your investment, active market of your asset, so you will always go for that. So quoted prices. So obviously, if you have made an investment and quoted prices are available from the stock exchange, so that is the most reliable fair value. Although pricing model developed by the financial controller that relies on the management estimate value. So how can I rely on 9.5? It's not logical at all. Can I say we should not be relying on 9.5? We have to go for 9 million, level 1 input. Obviously, when level 1 input is available, then why would I go for what management says? And what management says and management is estimating, that is level 3 input. When observable level 1 input is available, I will not go for any other input. So logically, 9.5 is not relevant. Based on Winston, strong working capital management and marketing optimism about the entity's forthcoming products, the bonds were still deemed to have a low credit risk. This is important. Students, if your investment is having a low credit risk, then you will be calculating expected credit losses, but according to the next 12 months only. Repeat, if your investment is having a low credit risk, then loss allowance should be therefore equal to the 12 months expected credit loss. But we know that if default risk increases significantly, then instead of 12 months expected credit loss, we go for the lifetime expected credit loss. But if default risk is not so significant, it is low. If the credit risk is low, credit risk is not increased significantly, then we do recognize the loss allowance, but according to the 12 months expected credit loss. Okay, come here. The financial controller of Aaron calculated the following expected credit losses. Can I say this is relevant for us? This is not relevant because it is mentioned in the question that your investment is still having a low credit risk. Now, what exactly you need to discuss in part C? There are many things, to be very honest, you can discuss in part C. Number one, while answering part C, you have to be really good in telling your examiner exactly the classification of the investment. The classification according to the business model will have to be fair value through OCI. First, you have to be really good in the classification of investment in debt instrument because business model is mentioned. That we'll keep the investment till maturity plus sell whenever a new opportunity comes which gives us a higher return than existing. So we'll go for selling it. So that is fair value through OCI, number one. Number two, just explain without doing any calculation accounting of fair value through OCI. Initially, fair value plus transaction cost. Subsequently, if interest income is recognized on the basis of effective interest, cash interest is received on the basis of par value. At the year end, remeasure the fair value and changes in the fair value, they go to OCI. At the time of disposal, cumulative previously gain or loss in OCI is recycled to P&L. First, you have to discuss all these things. After that, Since it is a requirement of IFRS 9 that at the year end, you have to remeasure the value of your investment to the fair value. There are two fair values available. One is 9 million and another is 9.5. Then you have to give the reference of IFRS 13 and IFRS 13, which deals with fair value measurement. And obviously when level 1 input is available, which is 9 million. So we have to take 9 million as a fair value rather than 9.5. Now, if I just show you a little bit accounting of your, I would say, investment of financial asset. We are making an investment. I'm just taking the date. Let's say if I go towards the date 31st May, or let's say we have made an investment on 1st June X6. So financial asset, we made an investment on 1st June X6, and it is mentioned in the question, the amount of investment is 10 million. So it means 10 million. Effective interest in the P&L, you have to take effective interest, finance income. Finance income. Here you can say brought down as well, no issue at all. Finance income is 15%. If I take 15% of 10 million, I'm getting 1.5 million. Interest received, cash interest received. Cash interest received is on the basis of par value. Cash interest received. Cash interest percentage is 5%. If you take 5% of 10 million, it will be 0.5. So 1.5 will be added, 0.5 will be deducted. So I'll get a total 11 million. Then difference, either it is gain or loss, that goes to OCI. Carrying up CD amount. Can I say CD amount will be 9 million? So logically, there's a loss of 2 million. And that loss goes to OCI. That loss of 2 million will go to OCI. If you ask me what will be the double entries, I just quickly, there's no need to make double entries. I'm just explaining you. If you ask me the entry of 10 million, so obviously investment is debited by 10, bank is credited by 10. Entry of 1.5, investment debit by 1.5, P&L credit by 1.5. If you ask me the entry of 0.5, cash debit by 0.5 and investment is credited by 0.5. I'm just making few entries for you. Investment 10, bank 10. Another entry, investment 1.5, profit and loss. That is interest income, finance income. Then entry of 0.5, bank 0.5 million debit, investment 0.5 credit. Okay. Then fair value is reduced by 2 million. Loss on fair value. OCI is debited by 2. Investment is credited by 2. I hope these double entries, they are clear to everyone. Now listen, final point. What is that final point? It is mentioned in the question that investment is still having a low credit risk. It means we cannot, the loss allowance will not be for the entire life expected loss. It has to be 12 months expected credit loss. Now listen carefully. Already your investment is having a fair value of 9 million. The question is, when it comes to SOFP, listen carefully. Investment value will have to be 9 million. Now listen. Investment value will have to be 9 million. Even though we have to recognize the loss allowance of 0.2 million, but we cannot reduce the carrying amount of the investment. Listen, if you reduce the carrying amount of the investment, then amount will become 8.8 million. Can I say which will be incorrect? Why? Because when the fair value is 9 million, so how can you reduce the value of your investment below 9 million? So since investment is already at fair value, so now loss allowance will be recognized, but it will be adjusted through gain or loss in OCI. If you ask me what will be the double entry of the loss allowance, so basically I will take that 0.2 million to the P&L. So loss allowance I'm going to take to the P&L 0.2, and OCI will be credited by 0.2. Actually, that loss allowance will be adjusted. That loss allowance will be adjusted through gain or loss, which is in OCI. I cannot bring that loss allowance to that 9 million and reduce the carrying amount of this 9 million. I cannot make it 8.8 in SOFP. Why? Because this is the fair value of the investment. They've asked us one more thing. What about the cash flow statements? Can I say Aaron is the investor? Aaron is the investor of the bond. So number one, investment in bond is an investing activity. Second, cash interest received. Cash interest received is also an investing activity. So students, I strongly believe this question should have given you a really good idea of IAS 32, IFRS, I would say 9 as well, and a little bit IFRS 13. Now, what I exactly want from you, each one of you, I'm not saying spend so much time after this video. Just I would say spend at least 10 to 15 minutes, not more than that. Do read the answer of this question from your Kaplan kit. Just read the answer at least once. The benefit would be all those concepts which we have discussed, to be very honest, you can retain them for a very longer period of time, but do spend at least 10 or 15 minutes on reading the answer. Students, I hope everything is clear to everyone. Just reply before we end the class. I hope this is clear to everyone. Clear? What about others, students? Before we end the session, it is clear?